Annenberg Media.
Why do countries import products instead of making them at home? Who wins when countries trade for goods and services? And who loses? Trade. What's the advantage? We'll find out when we look inside the global economy.
Hello, I'm Annenberg. As an international economist, I've spent the last 20 years of my life analyzing the global economy. And it seems to me that hardly a day goes by when the news headlines don't include an item relating to either a trade dispute, or a U.S. company moving its production overseas, or a foreign company buying a U.S. company, or some politician moaning about the lack of competitiveness in the U.S. economy. Even on a day-to-day basis, we seem to be buying more foreign goods and encountering more immigrants and migrant workers. All of these trends can be summed up in one word: globalization. Now, is this something to be feared or embraced? We'll answer this question in this Global Economy series by looking at a series of case studies from around the world, from North America, South America, Eastern and Western Europe, Africa, and Asia. We'll also hear from a panel of distinguished economists who spent their careers looking at these very issues. In this segment of Inside the Global Economy, we'll be talking about trade, and we'll look at two case studies, one in Japan and one in Australia. In subsequent programs, we're going to be talking about protectionism, trading blocs, capital and labor mobility, exchange rates, developing countries and economies in transition, that's the former Soviet bloc countries, the environment and how it relates to the global economy, and the evolving world economy. But first, let's define a term. What do we mean by globalization? Globalization is the increased economic interdependence and integration in the world economy. Now, in the post-war period, this integration has progressed along four fronts: trade, investment, technology, and finance. And let's show these graphically, looking at some data from the post-war period. To begin with, this is a snapshot of world trade flows around the world in the late 1980s. And it shows trade within four regions of the world: Europe, Asia, North America, and the rest of the world. And it shows trade flows among these regions. And the most notable thing about this particular set of numbers is that not only trade within each region, but trade across regions, let's say from Asia to North America, the volume of trade is bigger than most medium and small-sized economies. So we're looking at huge volumes of trade, and in the post-war period, this volume of trade around the world has increased 12-fold. Another way to look at the same data is looking at exports as a percent of GDP for these five countries: Canada, Japan, South Korea, UK, and USA. And from 1960 to 1980, you can see that trade, especially exports, as a percent of each of these economies, increased quite dramatically. More so in some countries, let's say like Canada and South Korea, than in others, but still, nonetheless, trade became more important. And there are a number of reasons for this. During this period, trade barriers fell. Also during this period, transportation costs and communications costs also fell. So that has been a major reason for this rapid increase in trade and trade openness, if you will, in the sense that trade has become more important for many of these economies. Let's look at the next force behind globalization, which is investment. And here we're looking at foreign direct investment in the U.S. from 1973 to 1989. And you can see that despite the wiggles and squiggles, that the trend is definitely upward. And this is investment by foreign companies in the U.S. If we took any other country, we'd see similar trends. And this is largely driven by one of the engines of globalization, which are the multinational companies that are investing all over the world. A third trend of globalization is technology. It doesn't lend itself very well to graphical analysis because the data is not that good, but trade in technology has increased some tenfold over the last 15 years, and this has to do with joint ventures on research and development, on cross-border education, and so forth. And finally, finance also has been a powerful integrating force in the global economy. Here we have the stock of international bank lending in 80 and 91, and the stock of bonds issued on international markets, also 80 to 91. And you see this very dramatic increase, both in volume terms and relative to the size of the industrial or the OECD economies. For example, in the case of bank lending, it's gone up from 4% of OECD GDP, the GDP of industrial nations, to 44% only 11 years later. In the case of the bond market, it went up from 3% to 10%. So again, a huge increase. Similarly, if we look at stock transactions, we see for three countries, the US, Japan, and West Germany, a very dramatic increase in the volume of securities transactions internationally for these three countries. Now, a number of factors underlying this. One is financial deregulation in many of these countries. The second is that through computerization and the communications revolutions that have occurred in the last 10 to 15 years, we're now seeing a 24-hour financial market around the world, and that has driven this increase in volumes. Now, why do countries trade? Well, countries can enjoy higher levels of consumption and also a greater variety of consumption if they produce those goods that they're relatively efficient at producing and import those goods that they're relatively inefficient at producing. Coming back to the personal example, it would be very inefficient for each of us to produce our own shoes, our own clothes, our own cars, and so forth. In fact, what we do is we specialize, we focus on those areas that we're good at, and we trade, in effect. We sell our services or our goods, and then buy those goods that we're relatively inefficient at producing, whether it's shoes or cars or what have you. Let's illustrate the gains from trade by looking at a numerical and graphical example. And it's important to start off by explaining that there are a number of simplifying assumptions that have been made here in order to produce this analysis. Some of it having to do with the fact that this is a static analysis. But nonetheless, the conclusions hold even once we remove some of the simplifying assumptions. Let's look at the example. Interestingly enough, it's an example from the 19th century, which looks at the US and the UK and looks at the production of wheat and cloth in both these countries and looks at where they end up if they trade and if they don't trade. Looking first at the US, we see that given the resources in the US, it can either produce wheat or cloth or both. If it just produces wheat, it produces 180 units of wheat. This could be millions of bushels, let's say. Or it could just produce cloth. It could produce 120 units of that. That could be, let's say, billions of yards of that cloth. Or it could produce somewhere in between. If it wants to do that, then there's a trade-off, an exchange. So every time it reduces wheat production by 30 units, it can increase cloth production by 20 units. So that's the trade-off. It's a 3-to-2 trade-off for the US. Going over to the UK now, we see that if the UK concentrates all its productive resources in wheat, it can produce 60 units of wheat. But if it focuses all its productive resources on cloth, it can produce 120 units of cloth. Now what's interesting here is the exchange here, or the trade here within the UK, is different than in the US. When the UK reduces its wheat production by 10 units, it increases its cloth production by 20 units. So its exchange is 1-to-2, whereas in the US, wheat to cloth exchange is 3-to-2. What this suggests is that the US has a comparative advantage in the production of wheat, whereas the UK has a comparative advantage in the production of cloth. It's interesting that underlying the US comparative advantage in wheat is the fact that it has a larger area, a much larger wheat growing area, so that gives it that comparative advantage. Now let's look at what happens when we don't have any trade. In this instance, we're showing the so-called production possibility frontier for the US, which shows this trade-off between cloth production and wheat production. And in this example, the U.S. decides to produce somewhere in the middle here, produces 90 units of wheat and 60 units of cloth. What about the UK? Well, in the case of the UK, it decides to produce 40 units of wheat and also 40 units of cloth. So that's the point it has picked along this production possibility frontier. Now, what happens when there's trade? Well, in this example, it's worthwhile for the U.S. to specialize in wheat, in which it has a comparative advantage, and then trade with the UK for cloth. So let's assume that that trade takes place on a one-to-one basis, 1 unit of wheat for 1 unit of cloth. And what's interesting here is now the U.S. is better off in the sense that it can now enjoy a higher consumption of both wheat and cloth by specializing in trading. Instead of 90 units of wheat, it now can actually consume 110 units, and then it trades the rest. And for that trade, it will get 70 units of cloth, whereas before it could have only gotten 60 units of cloth. So both in terms of cloth consumption and wheat consumption, it's better off. What about the UK? Similar kind of situation for the UK. It chooses to specialize in the production of cloth because that's what it has a comparative advantage in. And then it trades for wheat. So it will consume 50 units of cloth and trade the remaining 70 for wheat. So now instead of 40 units of cloth before, it can enjoy and consume 50 units. And instead of 40 units of wheat before, it can enjoy 70 units of wheat. So both the U.S. and the UK benefited from the specialization and the trade and can consume more of both goods as a result. Now, if we increase this to more countries, more goods, and remove some very simplifying assumptions, the basic conclusions still hold, namely that a country should play to its comparative advantage, to specialize in those goods, and to trade. Let's summarize the gains from trade. There are two basic gains from trade. The first is the production gain, as it's called, and that is from specialization. The second is consumption gain from international exchange. And this again applies to individuals. We're better off, we're more efficient if we focus our activities in one area. We become specialists, we become more efficient at it. And then we trade, and then we can gain the benefits both from the specialization and from the trade. Now, we've used a term here that's worth coming back to, and that's this notion of comparative advantage. It is perhaps the single most important concept in international trade. What does it refer to? Basically, what it says is that the mutually gainful trade is possible even if one nation has an absolute disadvantage in the production of all commodities. Let's look at it a slightly different way. What if one country was more efficient than another country in the production of all its goods? Why would it want to trade? Well, it turns out even under those circumstances, it's better for that country to focus its energies on those activities in which it has its greatest efficiency gains, as it were, and then trade for those products where it is relatively less efficient, as it were. Let me give you an example from U.S. history. The story goes that President Woodrow Wilson was an excellent typist. But instead of typing, he focused on being president and let his secretary do the typing. Because again, the country was better off with him becoming a president rather than a secretary. So in that sense, this is an example of comparative advantage. Yes, Woodrow Wilson was good at both things, but he had a comparative advantage in being a president. Now, comparative advantage is a dynamic concept. It's not a static concept. As we'll see when we look at this first case study that looks at the decision by IBM to move its design facilities to Japan to take advantage of Japan's comparative advantage.
Computers affect every aspect of modern business life. These boxes of chips make information more readily available. But on the inside is a tale of the world contributing specialist inputs. These memory chips were made in Japan. The floppy disk which stores the data was manufactured in Thailand. All the components were assembled in Taiwan. The software which drives it is predominantly developed in America. Why does each country play such a different role? How is it determined just who is best suited to do what? World trade routes buzz every day with the movement of billions of dollars worth of goods. But why trade when most countries could produce most things for themselves? Each country can supply some goods or services better or cheaper than others. To best use their resources, they tend to specialise in those areas. They exploit a comparative advantage determined by a range of factors. Comparative advantage may arise from an abundance of easily accessible natural resources. They're easier to extract and cheaper to sell. The advantage could come from climate. This industry would be unlikely to be efficient in a high rainfall area. For manufactured goods, advantage can hinge on the wage costs and skills of the workforce. But all these factors are subject to change. Professor Ross Garno from the Australian National University.
Oh yes, any study of economic history tells you, first of all, that comparative advantage is a dynamic concept. It is natural, and it follows from the concept of comparative advantage that it will change when economic development changes the abundance of resources or the efficiency of the economy in various activities.
Natural resources can be exhausted. Low wages can rise, increasing as the workforce becomes more highly skilled. In the 1950s, Japan had a comparative advantage based on labour. Wage costs were reasonable. The workforce was well educated. That sparked an influx of labour-intensive industry to Japan. At that time, the Japanese subsidiary of American computer giant IBM played a very basic role. The computers it sold were imported from America, where they were designed and built. Japan made only limited modifications, tailoring systems to the local character-based style of writing. Today, Japan is one of the world's high-tech capitals. It's at the cutting edge of new technologies, helping the country find new wealth and opportunities. That's caused changes in IBM Japan's role. It now exports more than it brings in. It's taken over from America the role of designing and manufacturing portable computers. As the Japanese economy developed, its comparative advantage changed.
The capital stock rose in the form of human capital, in the capital that people were carrying in their brains. Comparative advantage at this later stage of economic development shifted into high-tech activities, activities that depended on education and training. In some ways, the forms of capital that are most characteristic of a high-income economy. And so you've got comparative advantage shifting towards computer design.
Japan developed extensive infrastructure in electronics. The highly skilled workforce made important breakthroughs in miniaturization. As it developed an industry base to support the new technology, Japan was able to achieve vital economies of scale. It could make these products for a lower cost than other countries. When the portable computer was born, IBM Japan began assisting its American parent with design. But Japan's technology and industry base gave it an edge. Hajime Watabe is Director of Personal Systems Products.
We had experience, again, in Japan infrastructure, NEC, the Canons and Ricos, and building a very small camera, as an example, and fitting in a lot of logic inside a very small area. So we wanted to take advantage of that.
Within a few years, IBM America handed over its design and manufacture role to Japan. It's typical of the shift which has occurred throughout the computer industry. Japan dominates miniaturization, exploiting the comparative advantage based on skills and industry infrastructure. The American industry too has followed its comparative advantage. It still develops larger computer systems and dominates the production of software which drives both big and small machines.
They have long history in building a system software in the United States rather than Japan. That's why you see in the large systems, Fujitsu and Hitachi picked up IBM systems. NEC is working with Microsoft to pick up their own systems.
But once technology becomes standardized, other factors can determine where products are manufactured. Countries with low wages can offer more cost-effective production while still achieving the benefits of economies of scale. That's seen a range of countries take over manufacture of components, with more changes to come.
You evaluate just about every country in our region, and maybe some other region like India, where they do have skills, and determine whether we should remain in Japan or go back to the United States or move on to China, India.
The continual shift in where these components are produced highlights the complexities of comparative advantage. Technology, labour costs and expertise all play a part in where production will be located. And because the world is constantly evolving, comparative advantage, or who does what best, is likewise continually changing.
Some time ago, I was joined by some of my economics colleagues in Melbourne, Australia, to discuss this case study. They include Richard Snape of Monash University in Australia, Hervé Torres of the International Monetary Fund, Rachel McCullough of Brandeis University in the US, and Magnus Blomstrom of the Stockholm School of Economics. Let's see how the discussion went.
Rachel McCullough, why import what we can make at home?
The key to the concept is the relative resource cost of producing different goods, so that if we import clothing, we're able to free up resources, capital and labor in the United States, and use them in other activities where we're relatively more efficient. So we might import more of our clothing and produce instead products like, say, software, where capital and labor in the United States are particularly well suited.
Doesn't it make sense, though, so if you're growing cotton in one place, to make the shirts there?
That assumes the transportation cost, let's say, of bringing the cotton to where the shirt factories are as a major component of cost. Often it isn't. It also makes an assumption that the technology for producing shirts is available in the country that grows the cotton. So there are a number of considerations that play into this concept of comparative advantage. So it doesn't always make sense to produce the shirts where the cotton is grown.
But the comparative advantage is really a very subtle concept. And in that example, of course, it says comparative advantage in stages of production. One country has a comparative advantage in growing cotton, another because perhaps it's got a lot of sunshine and appropriate soil. Another country has got a comparative advantage in spinning it, and another perhaps in making shirts from it. And it's not always obvious where these comparative advantages lie.
Richard Snape, though, do we have a situation where some countries will have no comparative advantage?
Well, I think a personal example may help to illustrate that, and you may think I'm a terrible economist, but you haven't seen me do anything else. And in fact, it could be that I'm just bad at everything, and this is the thing I'm least bad at. And so it is with many countries. As you look at them, you say, what comparative advantage could Singapore have in this country which has no natural resources? It turned out to have a comparative advantage, of course, in location, that its airlines, it's become a center for airlines in the world because of its location. It got a comparative advantage through its skilled labor force, and of course it's doing things which reflect that comparative advantage.
Each country has a comparative advantage, because this is a relative term. You compare yourself or a country with another country. So by definition, it has to be relatively, either relatively bad or relatively good at something. So each country has to have a comparative advantage.
But if it springs to mind some very unskilled African labour force, what comparative advantage can we see in that?
Well, they might have a good climate, they might have a good earth, they might have a cheap labor that they can use for something, and they might be helped to develop a comparative advantage by a multinational corporation or something. So there are very different things that each country can do.
Javier Torres, can it lead to exploitation though?
Yes, in fact, some people have sometimes opposed a multinational coming to the country because they feel that the labor force is going to be exploited. They are going to be paid very low salaries, very low wages. And they will make everything possible so that this multinational goes somewhere else. And then the question is, well, what are those people going to do then? The alternative is not having any salary or any wage which to live on. The point is that a country may start producing any kind of product and then can move up to produce another one, or to produce it in a more sophisticated way or more efficiently, and then improve its level of life, improve his income. If a country has a real comparative advantage, it has to exploit it. And the concept of exploiting something hasn't had to implicate something wrong or something bad.
Heber, thank you.
To summarize what happened in the case study and in the panel discussion, basically, IBM decided to move its design operations to Japan to take advantage of Japanese comparative advantage in the design of computers. Now, what determines comparative advantage? Certainly one explanation is that the endowment of factors of production that exist in a country will make that determination. And these columns here that we have look at the endowment of various factors of production. On the very left-hand column, we have non-human capital. This is machinery and equipment. The second one is research and development scientists. Third, skilled labor. Fourth, semi-skilled labor. And finally, illiterate labor. And the columns each look at the world as a whole and then look at the shares that each country has in those factors. So, for example, in non-human capital, the U.S., let's say, has about a 1/3 share in the world economy. Japan, much less than that, about 15%. And what this suggests is that goods that require non-human capital, machinery, equipment, in other words, capital-intensive goods, are goods that the U.S. has a comparative advantage in producing. If we look at R&D scientists required in high-tech products, then the U.S. has a clear comparative advantage. You can see that it has about half the world's share of R&D scientists. So this is clearly an area where the U.S. has strength. Japan isn't that far behind, and in fact, this is a picture of the 1980s. In the 1990s, the Japanese share had increased in this area, so Japan also now has a comparative advantage, as we saw in the case study, in high-tech kinds of products. If we switch over to skilled labor, the U.S. comparative advantage shrinks somewhat, and that of the rest of the world increases. It's still an area where the U.S. may have some comparative advantage. But as we get into semi-skilled and illiterate labor, it's clear that the kind of products that require those kinds of labor are ones in which the U.S. really does not have a comparative advantage. Now, we've talked about comparative advantage and the foundations underneath comparative advantage. But clearly, a number of myths have developed about comparative advantage in trade over the years, and it's worth mentioning 5 of them and talking about them briefly. The first is that free trade only helps those countries that are competitive. Well, this is not true. Free trade helps all countries that engage in trade because it helps to focus their energies on those activities and on those sectors where they have a comparative advantage or where they're relatively efficient. Second, foreign competition is unfair and foreign wages are too low. Well, if this were really true, if low wages were the basis for comparative advantage, then countries like Tanzania or Bangladesh or Haiti would be exporting powerhouses. They're not. It's the high-wage countries like the US and Germany that are the exporting powerhouses. Why is that? Because it's not just low wages that matter, but also productivity that matters, efficiency that matters. So it's the link between those two that's critical. Third, trade exploits poor countries. Again, the notion being if we condemn low-wage countries or poor countries to continue to produce unskilled kinds of jobs and unskilled kinds of products, then in fact they'll be doomed forever. The answer is no, that's not true. That countries gain, in fact, from producing those goods in which they have a comparative advantage. And if it means a comparative advantage in products that require low-skilled labor, then by all means, let them take advantage of that. Let them specialize in that and then trade. And eventually, as they move up the development ladder, they can move into other products. Fourth, this notion that exports are good, but imports are bad. Again, not true. Perhaps the biggest gain from trade is that it gives consumers a much greater choice of imported products, of products from all over the world, at a much lower price than could be possible if every good was produced internally or domestically. And you can think of exports as being a way to pay for those imported goods. And then finally, this notion that American goods create American jobs and that trade somehow or other hurts the job prospects in the U.S. Not true, again, in the sense that trade has very little to do with the overall number of jobs in the U.S. economy. What it does influence is the mix in the jobs, the composition of the jobs. So if we trade, we tend to play to our comparative advantage, and we get employment gains, more jobs in those areas and those industries where we have a comparative advantage, and fewer jobs in those areas and industries where we have a comparative disadvantage. So in that sense, trade changes the composition of our jobs, changes the mix, but really has very little to do with the overall number of jobs that there are in the U.S. economy. Now, we've talked so far about comparative advantage as being one of the bases, one of the incentives for trade, but there are also other examples and other reasons why countries trade. We've listed 4 of them here. The first is economies of scale. There are certain industries in which you really need the whole global market, in which the investments are so large that you really need to sell into the whole global market. Aircraft are a perfect example of this in the sense that to build a jumbo jet requires many years of investment, large factories and so forth. So to reap the benefits of that, you really need to sell to the economy, to the world economy as a whole. Second, intra-industry trade. An example of this is the automobile industry. You have autos produced in Europe, in the US, in Japan. And in fact, we buy autos from Japan and Germany, and we sell autos there as well. Why is that? Well, it's a very complex market, a lot of different product lines. It's a highly differentiated market. We may buy sports cars from Germany, fuel-efficient cars from Japan, and internally, we may buy minivans and pickup trucks and so forth that we're particularly good at producing. So in that sense, there's trade within an industry, but it's related to the fact that the differentiated products and different product lines. Third, trade may be motivated by technology gaps. If the U.S. has an advantage in a particular technology, then it can, in fact, take advantage of that in trade and trade those kinds of products for others. So a gap in technology can also be a basis for trade. Finally, something called the product cycle. When a new product is invented and produced, often it requires high levels of research and development, very highly skilled labor and so forth, as the product goes through its initial phases. However, once that product becomes standardized and it's being mass-produced, it doesn't require all those highly skilled individuals, those research and development scientists. It basically requires fairly low-skilled workers to do the mass production. So therefore, at that point, the production of that particular product will move to a developing country, let's say Thailand, and so that can be the basis for trade. Initially, the product is produced in a country like the U.S. and sold to Thailand, but eventually Thailand's comparative advantage comes into play in terms of mass production and is produced in Thailand and sold back to the United States. So from that perspective, any number of these factors can play into a motivation for trade. Now, clearly, trade produces not only winners, but losers. And let's look at both of these. Clearly, the biggest winners are consumers because, again, they have a much wider choice of products when trade takes place and typically at a much lower price. So they're the clear winners here. Also, the exporting industries, those industries in which, let's say, the U.S. has a comparative advantage, are also big winners. And third, the economy as a whole wins in a number of ways. The first is trade brings about greater efficiencies in the production of goods because of specialization. The other is greater economies of scale as we now can sell into the global market. So both the scale economies and the efficiencies will often put an economy on a higher growth trajectory with trade than it would get without trade. But there are also losers, and the primary losers are the industries and workers in the import competing industries. Those are the industries in which a country like the U.S. has a comparative disadvantage. Now, it's important to emphasize that there are adjustment costs with these industries losing out. People get laid off, they lose their jobs. But the point of international trade is that just because they're losers doesn't mean that you should stop the process or in any way impede the process. Rather, to help the people who've lost out integrate into those industries that are doing well, in which there is a comparative advantage. To illustrate this problem with adjustment and the sectors that lose, let's look at our second case study that looks at what happened to the Australian automobile sector when the mineral sector in Australia was booming.
The late 1960s saw Australia revelling in its title, the lucky country. It was enjoying an economic boom. Rich with mineral and primary resources, it supplied expanding world markets and reaped the rewards. National income soared, but the new wealth didn't bring good times for all. The boom didn't help the car industry. Its sales plummeted. Workers were retrenched. Plants closed down. The nation's boom was helping push the car industry close to bust. Working the land made the late 1960s and early 1970s one of the biggest economic boom times Australia had known. The world was hungry for its agricultural products and paying record prices. Sales of beef, wheat and wool skyrocketed. Beneath its crust, the land yielded the minerals needed by other countries. In just 4 years, Australia's total exports more than doubled. The country was suddenly rich. Sir R.V. Parbo saw the wealth flood in from the boardroom of one of the country's biggest mining companies.
The perceptions in this country were that we just had unlimited wealth continuing to flow in, and politicians made speeches about it. They said we were the blue-eyed Arabs of the South Pacific. And there was no concept that there would be an interruption to this flow.
For most Australians, the lucky country lived up to its name. Money flooded in from international sales. Australia's real national income rose by 20% in 4 years. That extra income gave Australians more to spend. Car workers' wages rose, increasing costs to an already troubled industry. It survived behind a wall of high tariffs, which made cars more expensive for Australians to buy. Without protection, the local industry couldn't compete with overseas producers. The boom made those inefficiencies even more acute as imported cars became cheaper. As foreigners purchased Australian dollars to pay for resources, the value of the currency rose. In 4 years, the Australian dollar appreciated more than 30% against its American counterpart. Unlike most, it held its value against the Japanese yen. Economics professor Bob Gregory from the Australian National University documented the effect on the car industry.
Cars which previously were being imported at, say, $15,000 suddenly become imported at much cheaper prices because of the exchange rate. And the tariff's no longer enough to protect the local industry, and hence the local industry suffers.
Even if the car industry had operated efficiently, it would have been hurt as competitors' prices dropped. But its inefficient reliance on tariffs made the pain much more severe. Australians bought the cheaper imports in their thousands. Demand for locally made cars slumped. The wheels of the Australian car industry were close to falling off. Sir Brian Ingalls was managing director of Ford's Australian operation.
Our tariff war was insufficient to protect the industry, or it was such that they could leap the tariff war and still sell competitively with local manufacture.
Its reliance on protection meant the car industry didn't operate at optimum efficiency. When imports became cheaper, it could no longer compete. Stockpiled cars filled storage yards to overflowing. Production was wound back. Thousands of workers retrenched. British car builder Leyland stopped making cars in Australia. It joined other European car makers like Volvo and Volkswagen and closed its Australian assembly plant. Even General Motors and Ford questioned if they had a future in Australia.
It's not a high-profit industry. If you sustain losses over a lengthy period, you're not going to remain. But I think the case was put by the industry that it was in the national interest to maintain the industry at least as it was, and the government responded to that.
The response was to raise the protection wall even further. Tariffs and quotas limited the number of imports and made them more expensive. But the cause of the inefficiency lingered. Not until the 1980s were models standardised and production runs lengthened to increase economies of scale. Industry Minister John Button initiated the changes.
The process of structural adjustment was much more painful in Australia because it came 10 years too late. The market was too small, and there was no concentration on exports. There was no possibility of expanding the market other than every Australian buying 6 cars or something. And the fundamental philosophy was just wrong.
The 1970s boom didn't help the car industry. It made the existing problems much worse. The country was becoming rich by exporting resources, but the extra trade was disadvantaging import-competing sectors of the economy, particularly the car industry. The car industry hadn't made the best use of its resources, and as imports became cheaper, those inefficiencies took the Australian car industry close to the end of its road.
Let's go back to Australia to see what the panel had to say about this case study.
Richard, how can trade be beneficial when there are losers in the process?
Well, any change in society will normally bring some losers as well as some gainers. Every technological invention is going to put some people who have got skills associated with an old technology out of business, and they will be lost. But that's the way in which the income of the society grows. And so there's a very close parallel in this with international trade. Specializing on what you're best at, specializing on comparative advantage, is a way in which a country's income can grow as a whole. But, of course, importing the things in which you're relatively poor at producing will, in fact, adversely affect the people who are doing that.
I think it's really important to emphasize the fact that inevitably there are losers, but the economy as a whole gains. And that's a very, very important sort of message here about international trade.
But what do we do about the losers? Do we just let them out to the forces of change and winds, or do we actually look after them? Do we put them on welfare? How does it work?
Well, I think there are things that the government can do to ease the pain. One thing that, as economists, we feel very strongly that what you don't do is interfere in international trade. That is not the way to protect the ones that would lose from this process. There may be ways of compensating their income, helping them get training, helping them in this adjustment process. That the government can do, but an absolute no-no, as it were, from an economist's perspective, is interfering in trade as a way to ease the pain.
It's a way of facilitating the movement into more productive areas. When they become unproductive in a particular area, they're facilitating a move into other areas. Now that in some cases is going to be very, very difficult, and in some cases impossible. How can an aged worker who's nearing the end of their productive life, who's got an investment in a particular industry, how can they be looked after? But this is not something which is uniquely associated with international trade. It's associated with any growth of society.
Technical change.
Yes.
Well.
I think the key political problem for trade policy is that maintaining an open market creates some very visible losers, whereas the gains are spread over consumers as a whole, and that's not just the final consumers like you and me, but also the industries that consume imported products who benefit from the open market. So because the losses, to the extent that there are some, are rather concentrated and visible, and the gains are diffused over the entire economy, the politics tends to favor stepping in and doing something.
Richard, if we look at the specific example that we've seen with the car industry in Australia, isn't there an argument for scaling down of protection over time, thereby minimising the dislocation to workers?
Yes, well, we're really not sure whether the planned reduction of protection in Australia was in fact good, that is to phase it over time, was in fact good or bad from an economic point of view. What it did was to address the politics of it. And the planned reduction through the Button Plan, which was mentioned in the case study, was in fact a means by which the workers and the industry and the union movement was got on side, and so that it facilitated the reduction of protection. And whether that's the way, that was a political judgment, which may or may not have been correct, and we don't know from an economic point of view, really, whether it would have been better to hit it in one hit or to make it gradual over time. That the politics of it suggested that to plan it in that way was a way of bringing it about that may or may not have been feasible otherwise. If one is attempting to resist all the changes that are occurring, one tends to dam them up and dam them up and dam them up, and eventually you're building up more and more forces behind this dam of wall, and eventually it breaks. Eventually you say, we can't resist these changes anymore, we have to have the changes. And we've got some very good examples, for example in New Zealand, where they tried to resist change for long and long and long and long, and finally they came in and said, we have to change. Now it's a good it may be worse, in fact, to be damming it up and resisting it in this way and having it all a big bang. It's almost certainly better to have it gradual change.
Is there an argument then in staging it, in actually having policies in place that minimise that dislocation?
Well, you have to be very careful as prices fluctuate, because they may be signaling sort of changes in the market that you actually want to adjust to. And so that's why, I'd be very cautious to say that you want to somehow or other compensate for price change, or the government would want to compensate for price changes, because there may be important information in there about the relative sort of importance of an industry, or the way resources should be allocated in a given economy to play to comparative advantage and so forth. So you really don't want to be interfering with the workings of a market and a price mechanism.
Nariman, thank you very much.
As we saw in the case study, there were winners and losers from the Australian export boom. Let's see if we can reinforce some of what we learned so far by looking at some graphical examples. This particular set of graphs shows the U.S. cloth market before and after trade. We've got the supply and demand curves for cloth. The demand curve slopes from the top left to the bottom right. And what it basically says is as the price of cloth goes up, people will buy less. The supply curve slopes upward from the bottom left to the top right. What that says is as the price goes up, producers will produce more cloth because it's more profitable for them to do so. Now, without trade, the supply and demand meet at the point where the price of cloth in the U.S. is $2 per yard, and the amount of cloth sold is 40 billion yards per year. Now, when you allow trade to take place, in effect what's going on is the assumption, which we'll see in a little while, that cloth outside the U.S. is being produced at a lower cost than in the U.S. So the immediate effect is to lower the price of cloth in the U.S. market when you allow trade to take place. And that has two impacts. The first is, because the price is lower now, more consumers will buy cloth, and they'll buy more cloth. So therefore, we move downward on the demand curve, whereas because the price has fallen, U.S. producers of cloth will produce less because it's now less profitable to produce that volume of cloth. So we move downward as well to the left on the supply curve. And the gap between demand and supply at $1 per yard is made up for by imports from the rest of the world. In this case, we're importing 40 billion yards of cloth. Now, in this instance, in the U.S., who are the winners and losers? Well, the clear winners in this example are the U.S. consumers because they can buy more cloth at a lower price. And their gain here is shown by this shaded area. Who are the losers? Well, the losers are the U.S. producers of cloth because they sell less at a lower price. Their loss is indicated by the shaded area in this graph. What about the net effect here? Well, it turns out that the gain to the consumers is larger than the loss to the producers. So the net gain to the U.S., and it's a gain, is shown in this triangle, which shows the difference between the consumer gain and the producer loss. So there's a net gain to the U.S. from trade. What about the rest of the world that's selling this cloth? Well, this shows the supply and demand for cloth in the rest of the world. And what we see is that without trade, in fact, the price would be only 50 cents per yard, and the volume sold in the rest of the world would be 60 billion yards. What if export takes place with the U.S.? Well, the price increases because remember that the U.S. price was $2 a yard, so that the price goes somewhere in between the two, let's say to $1 a yard, which is our example here. In that example, because the price is now higher in the rest of the world, consumers in the rest of the world will buy fewer or less cloth, and so that means we move backward on the demand curve to the left. Whereas because the price has gone up from 50 cents a yard to $1 a yard, foreign producers in the rest of the world, will produce more cloth because it's more profitable for them to produce more cloth. So that we move upward and to the right on the supply curve. And that gap is what's exported. The difference between the supply and demand in the rest of the world at $1 is the gap in the rest of the world that's exported to the U.S. Again, let's look at the winners and losers in this example. The winners now in the rest of the world are the producers, the exporters of cloth, and their gain here is shown in the shaded area, which shows that they're selling more at a higher price. The losers are the consumers in the rest of the world because they buy less at a higher price. So their loss is this shaded area. However, again, the net is a gain to the rest of the world because the gain to the producers is larger than the loss to the consumers, and this gain to the rest of the world from exporting cloth to the U.S. is shown by this triangle, this shaded-in triangle. So both the rest of the world and the U.S. gain from trading cloth. Where does all this leave us about trade? What's the bottom line? Well, it's useful to look at both the economics and the politics of trade. First, the economics. Trade is a positive-sum game in which the participating countries and the world as a whole gain, even though there are some losers. Now, trade is not a zero-sum game in this sense that if one country gains, it doesn't mean another country loses. The great thing about trade is both countries gain from trade. However, the politics are more complicated than that. Because the losers from trade, the unemployed workers, and the import competing industries are visible and vocal, we tend to notice them. However, the gains from trade tend to be much more diffuse and distributed among a much larger group that tend to be silent, the so-called silent majority. And it's in fact this tension between the economics of trade and the politics of trade that keeps trade in the news headlines. For Inside the Global Economy, this is Nariman Barabash.
Annenberg Media. For information about this and other Annenberg Media programs, call 1-800-LEARNER and visit us at www.learner.org.